Okay, we now welcome our second panel to the program. We will be hearing from Lisa Glover of U.S. Bank, speaking on behalf of the Consumer Bankers Association, Robert Manuel of Wells Fargo and Company, Tish Seacrest of Bank of America, Barbara Boone of Alliance Bank, Andrew Gordon of Arizona Multibank Community Development Corporation, and Fred Mendez of Rabobank N.A. So, Ms. Glover, why don't you lead us off?
All right, thank you. Good morning.
Good morning.
My name is Lisa Glover, and I'm the Director of Community Affairs for U.S. Bank, which is the fifth largest commercial bank in the United States with assets of $282 billion. I'm testifying today on behalf of the Consumer Bankers Association, and I appreciate the opportunity to present the views of CBA on the CRA and the prospects for improving it. CRA was established to encourage banks to help meet the credit needs of their entire communities, including low and moderate income households and neighborhoods. While the Fair Housing and Equal Credit Opportunity Acts, among others, were designed to provide comprehensive safeguards for consumers and minority groups, CRA remains the only federal law focused on the needs of the population that are not considered protective classes, but may be historically underbanked or underserved. We believe the focus needs to remain solely on those households and neighborhoods. We hope the agencies will try to avoid trying to make CRA all things to all people, which would stress resources too broadly and dilute its effectiveness. The agencies have asked if the evaluation or data requirements for small business, small farm, or consumer lending activities should be changed, and we offer the following. In the evaluation of small business data, it's the experience of CBA members that while some examiners consider demographics, market conditions, and product mix, the amount of consideration examiners seem to give these vary, with demographics often getting the most weight and attention. We feel the demographic measure does not comprehensively reflect whether a bank is helping to meet the credit needs of a community, since it does not take into consideration important factors such as credit risk or demand. We recommend that the agencies take a broader view and place greater weight on parity with the industry and a bank's product mix rather than emphasizing only demographics. We feel these measures provide reasonable proxies for demand and credit risk that are missing in today's current analysis. The mandate that small business lending be tied solely to low and moderate income geographies needs to be reconsidered. Small businesses are not like individual consumers or families that are demonstrably low or moderate income. A small business may be located outside of an LMI community and provide services that help stabilize an LMI community or employ individuals who are LMI. In today's world, it needs to be recognized consistently that loans to small businesses outside of LMI areas can equally benefit LMI individuals. Under the Dodd-Frank Act, the Equal Credit Opportunity Act will now require small business data to be collected on by all those covered entities providing credit. Many of those entities also report CRA small business data. The Consumer Financial Protection Bureau will be writing the regulation to implement the new ECOA requirements. However, the Bureau does not have responsibility for the regulation or oversight of CRA. We are concerned that the new reporting requirements may conflict with CRA, creating unnecessary burden for the industry, raising costs for consumers and small businesses, and creating confusion for the public. We would encourage you to coordinate with the new requirements with the CRA so there are consistent reporting requirements. Finally, we feel it's important that consumer lending remain optional. If it were mandatory, it would shift the focus away from the products where the needs are the greatest, namely mortgage, small business, and community development, to products where there is no evidence of a shortage of needs, particularly in low and moderate income communities. The agencies have also asked if we should consider changes to CRA disclosures performance evaluations. We offer the following comments. Currently, the emphasis in the examination process is on full scope areas. These are areas within the bank's market where the examiners focus the most attention and tend to be the bank's largest deposit market within a state. These full scope markets are the same for many banks, and with multiple banks competing for the same opportunities, some of these markets can overheat. Conversely, rural areas and smaller markets are shortchanged, while resources are driven towards the full scope markets. To bring resources to more markets, we recommend banks be able to select markets with demonstrated needs in which to have full scope examinations. We feel this would bring resources to smaller, more underserved markets. In recent years, performance evaluation have reduced the level of detail. As a result, they have declined in value, and it's harder for the public to determine why an institution received the rating that they did. We feel less generic narrative and more detail about the specific activities undertaken by the bank in a given market would be more beneficial to the public. Currently, exams are timed so the next exam assesses performance for a period that begins before the last performance evaluation has been finalized. Often the performance evaluation will be issued for the prior period when a bank is more than halfway through its current evaluation period. This makes it impossible for banks to change their performance based on the results of one exam before being subject to the next exam. We would urge the agencies to establish a minimum period of time between the publication of performance evaluations and the subsequent examination. CRA has been a catalyst for improving the lives of LMI people. However, CRA can be improved. As the regulations are reformed, it's important to ensure that CRA remains focused on its core purpose while ensuring a strong link to safe and sound practices. Thank you for giving us the opportunity to be a part of this process.
Thank you. Mr. Manuel.
Good morning. My name is Robert Manuel, and I'm Director of CRA at Wells Fargo & Company. We are a diversified financial services company with $1.2 trillion in assets and more than 278,000 team members across our 80-plus businesses. We provide banking, insurance, investments, mortgage, and consumer and commercial finance through more than 10,000 stores and 12,000 ATMs and the Internet across North America and internationally. I appreciate the opportunity to provide Wells Fargo's perspective on how the CRA regulatory process can be enhanced. We commend the agencies for their continued efforts to develop regulatory guidance for CRA compliance. Wells Fargo supports the CRA and strongly believes that it has been an effective law to revitalize local communities and underserved populations consistent with safety and soundness. Our comments stem from a goal to promote increased sustainability CRA programs in a volatile and challenging economy and within a dynamic regulatory and business environment. We believe that this goal can best be furthered through greater flexibility in how the CRA exam procedures are applied. We believe there needs to be more consideration for activities that have high community impact and are most responsive to critical needs in local communities. There also needs to be more consideration for the opportunities and challenges of the environment in which an institution does business. We believe that the CRA is most effective when there is a strong link between a depository institution and the local communities that it serves. Our obligations under CRA should be tied to our capacity to reasonably ascertain and serve the specific needs of our communities. This tie is strongest when an institution has a physical presence through traditional deposit-taking branches and team members in communities. CRA public performance evaluation should be an opportunity to reinforce the connection between an institution's activities and the local communities it serves. The basis of an institution's performance should be the unique needs of local communities as determined through community contacts as well as the institution's efforts in working with community-based organizations. This should be described in the performance evaluation before CRA performance is assessed. There should be a balance between quantitative and qualitative factors considered when assessing performance. The recent trend of streamlined performance evaluations has focused on standardized quantitative comparisons such as lending and branch distribution to demographics. As a result, qualitative elements such as performance context and CRA highlights are not emphasized, and therefore a complete picture of an institution's performance cannot be obtained. Oftentimes, the best examples of how an institution has collaborated with community-based organizations to find the most impactful ways to address the most critical needs in its communities can provide the public and the industry with innovative and creative approaches to CRA. These activities can also differentiate CRA performance among institutions. The performance evaluation should also provide an opportunity for the institution to highlight its efforts in the communities that it has identified as having the most critical needs, regardless of their aggregated deposits. This is particularly critical for rural or historically underserved markets. As recently demonstrated, several markets impacted by high foreclosure rates outside the large metropolitan areas, such as the California Central Valley, had greater credit needs with fewer resources to meet those needs. If their efforts were given appropriate consideration in the CRA examination and acknowledged in the performance evaluation, institutions would likely do more to meet the credit needs of these communities. In short, these qualitative efforts need to be given more weight. With regards to enhancing the data collection, reporting, and disclosure requirements, the agency should require annual reporting for the number and dollar amount of community development lending aggregated at the county level. This will provide more detail of community development lending by geography and allow for market and industry comparisons. The regulatory agency should also coordinate with the new Consumer Financial Protection Bureau any new data collection requirements for small business loans under ECOA as referenced in the Dodd-Frank Act. There should be a uniform standard for small business data collection consistent with data collected, reported, and examined under CRA currently. With regards to small business lending, we believe the CRA evaluation of this activity on the lending test can be enhanced. its weight for an institution's performance should be determined by how much it has been identified as a critical need in an institution's communities. This differs from a strictly quantitative approach of weighting performance by lending volume. For example, Wells Fargo is one of the largest originators of both mortgage and small business loans and historically has originated a greater percentage of mortgage loans than small business loans. However, given the high level of unemployment in most of our communities, job creation is an even more critical need at this point in the economic cycle. As small business lending is a primary means of addressing this need, it should be weighted more than its percentage relative to mortgage lending on the CRA examination and acknowledged in the performance evaluation. In addition, there should be more balance between the quantitative and qualitative factors considered when evaluating small business lending performance. The geographic distribution of an institution's small business lending to small business demographics is still a relevant quantitative measure for performance. However, qualitative factors such as market conditions, credit demand, tighter underwriting requirements, and competition that may impact performance likewise need to be considered. Finally, small business-related activities such as providing technical assistance and tools to assist small businesses that may not necessarily directly generate a large volume of loans, but are designed to be very responsive to the needs of local communities, should also receive significant qualitative CRA consideration. Once again, we commend the agencies for their continuing efforts to provide staff guidance for CRA compliance. Wells Fargo appreciates the opportunity to provide additional recommendations to enhance the CRA regulatory process. We believe these recommendations can be implemented with minimal burden but maximum benefit for financial institutions and community-based organizations to develop and participate in sustainable CRA programs for years to come.
Thank you. Ms. Sechrest.
Good morning. I'm Tish Sechrest, Chief CRA Officer for Bank of America. We have always been and remain a proponent of CRA. Nevertheless, we advocate for reform because the spirit of CRA should be restored by adopting new rules that reduce the immense complexity that has evolved over the 30 years. You have asked that we provide comment on 3 areas, and we offer the following. Bank of America is the largest provider of financial services to small business owners in the United States with more than 4 million customers. The statutory directive of CRA is to ensure that banks meet the needs of its entire community, including low and moderate income neighborhoods. This two-pronged view for encouraging, assessing, and recognizing the full impact of a bank's lending should be preserved. To this end, we suggest the following changes. Inclusion of all loans to businesses with revenues less than $5 million. If the intent is to support small businesses, the size of the loan and location should be irrelevant. Inclusion of all business loans within LMI areas. These loans are economic engines and anchors that provide stability and jobs within the LMI neighborhoods. Inclusion of all SBA or other government-guaranteed lending. Additional credit for small loans to businesses less than $100,000. Inclusion of all small business loan modifications. Inclusion of products, services, and technical assistance for a holistic view of small business. Exclusion in the analysis of businesses where revenues are unknown, consistent with HMDA analysis. And consistency in data collection and reporting requirements between the CFPB and CRA. With regard to consumer lending, Bank of America recommends that it remain optional based on a bank's business strategy. Requiring it would further overemphasize lending and shift focus from needed banking and community development services. With respect to performance evaluations, we have several recommendations, and I'll touch upon 2. First, community development activities are at the heart of CRA, yet they are undervalued as additive. These should be elevated in importance and carry more weight within the 3 performance tests, or they should constitute a new standalone test. Secondly, performance context is an immensely important factor to meaningful data assessment. It should be taken into account in all geographic markets. And if context is truly valued, there should not be expectations nor evaluations based on year-over-year or exam-to-exam increases. The past 3 years underscore the economic cycles do occur, and performance may be adversely affected. Now, turning to CRA data collection, reporting, and disclosure, Bank of America supports the continued CRA focus on income. However, we would recommend that CD lending be reported at state or MSA levels to provide peer and industry analysis, that quantitative data tables be separated from the qualitative narratives so that a full assessment of impact and results are not lost in the numbers, and that qualitative assessments should clearly describe impact in all markets, not just in the full scope areas. Briefly, I'd like to address another area, and that's access to banking services. The headline here is that customer behavior has changed dramatically, but banks are not receiving CRA credit for the creative and innovative ways that they are responding. More transactions are done by all of our customers through our ATMs than in our banking channels. Telephone and online banking usage is approaching parity with the market demographics. And while mobile banking is still viewed as emerging, we expect this to be a game changer for all customers, with U.S. cell phone penetration reaching upwards of 90%. Banks receive virtually no CRA credit for providing state-of-the-art options for access. Regulatory emphasis on banking centers is limited and outdated. Similarly, there should be substantive credit for products and services that benefit rather than specifically target LMI customers. For example, we were the first bank to join the Bank on California program for the unbanked. However, because we used a low-cost, mass-market checking product, we received negligible CRA credit despite our leadership. Earlier this year, we introduced an industry-leading overdraft policy, yet we will receive no CRA credit for its profound positive benefit to LMI customers. It is time for a broader view of access, and redistributing service test weightings will help promote greater access. In conclusion, the end result should be the mutual gains that come from maintaining a strong banking industry and creating strong communities. As the agencies consider ways to increase impact and reach, safety and soundness must be kept in balance. This is the linchpin to having CRA continue to be relevant, viable, and impactful for the next 30 years. Thank you for the opportunity to be part of these discussions.
Thank you very much. Ms. Boone?
Thank you for the opportunity to be able to speak at this CRA public hearing. My name is Barbara Boone, and I represent Alliance Bank of Arizona. We are a community bank, and we've just reached over $1 billion in total assets. But I have been with the bank from small to intermediate, and next exam we will be a large bank. I've been a CRA officer for many years at different banks. Most of them have been community banks. So my first recommendation is to increase the size standard for the definition of a small business from $1 million or less in annual gross revenues to $7 million or less in annual gross revenues. I also am going to address how I think we should standardize the performance evaluation for banks. Defining a small business as a for-profit organization with gross annual revenues of $1 million or less is too restrictive and does not properly reflect the nature of a small business lending that is occurring for CRA purposes. The Small Business Administration has a broader size standard definition of a small business and should be used as a reference in determining the definition of a small business for CRA purposes. The SBA, Small Business Administration, refines the size standard of a small business every 5 years. The measure is defined by either the employment size of the firm or the gross revenue figure. In general, the size standards can be measured by the concern's average employment for the preceding 12 months or the basis of annual gross receipts of a business over a period of not less than 3 years. For example, the SBA has adopted 500 employees as a standard for manufacturing industries and $7 million in annual gross revenues for non-manufacturing industries. It was in 1954 that the SBA first adopted the figure of $1 million in gross revenue size standard. And the standard has been periodically adjusted by the SBA to account for general inflation of the economy, startup costs, competition, entry barriers, and size distribution of the firms. And currently, the size is $7 million. Moreover, the $7 million captures the $7 million in revenue continues to capture the size of business to typically use the SBA's financial assistance program as a source of credit. Therefore, to properly account for the majority of the SBA loans and a more current size definition of small business, it would make sense to increase the CRA small size standard of $1 million or less to be more in line with the SBA's anchor size standard. A lot of times when we do our evaluations, We do quite a bit of small business lending in low to moderate income areas, but because of the revenue size standard, it does not get counted for making a small business loan. My second recommendation is to take affirmative steps to promote consistency in the performance evaluation. Over the years in my CRA experience, I have worked with different agencies in doing a performance self-assessment. And I have learned that there's different standards and different way of calculating requirements to meet CRA effectiveness. For example, for small business lending, some agencies have adopted the FFIEC tables to do your evaluation, whereas some of the agencies are not using the FFIEC table. So there's different forms of measurement. So depending on which agency is doing your performance evaluation, you could reach different standards and different conclusions. And for years, the FFIEC tables for the bank's mortgage loans and small business lending, not only does there seem to be not consistency between the agencies, but also between the field examiners and how they actually look at it and what their measurement is. Likewise, the same is for investments. For example, some agencies measure investments compared to total assets, and some measure it to Tier 1 capital. So again, you can reach different results. And finally, the other is the service test and how many service hours that you actually do perform. Some agencies, it's really ambiguous how we really come up with what is an adequate amount of service hours. And some agencies will criticize you because senior management's not performing those service hours. And then some examiners will criticize you because you're not doing enough service hours in your remote areas. So I want to thank you for listening to my recommendations of increasing the size standard of a small business loan, and also in making consistency, and it would be more effective if we could understand and take the mystery out of what a lot of the benchmarks are in an evaluation, so we know how to receive an outstanding, satisfactory, or we need to improve in certain areas, and we knew what those benchmarks were. Thank you very much for the opportunity.
Thank you. Mr. Gordon?
Thank you for the opportunity to testify on modernizing the Community Reinvestment Act. My name is Andy Gordon, and I'm speaking with you today not as a student or an expert on CRA, but as a practitioner of community and economic development. In fact, 3 of my investment banks are right down the table there. I have over 30 years of on-the-ground experience in community development and lending, from rural Nevada as a VISTA volunteer in the 60s to in the 80s doing urban development action grant lending in New York City, to the last 20 years as the founding president of Arizona Multibank Community Development Corporation. In many ways, Arizona Multibank, its customers, and I are beneficiaries of CRA. It is from this viewpoint that I wish to share some of my observations. Arizona Multibank is a nonprofit community development financial institution, and we have provided 400 loans totaling $43 million throughout Arizona, serving urban, rural, and Indian country. In 1991, the OCC, the Federal Reserve Bank of San Francisco, the FDIC all played a very important role in guiding us and our prospective bank investors in structuring a strong organization and financial platform so we could be proactive over the long term, and I emphasize long term, in our mission of responding to legitimate unmet credit needs in our Arizona communities. Valley National Bank of Arizona, along with Arizona Bankers Association, led the charge in banking, in the banking community to establish Arizona Multibank. At the time, I knew little about CRA, but Valley National Bank, the largest bank in Arizona, soon to be Bank One and J.P. Morgan Chase, was obviously motivated to take the lead on this initiative with the regulators, primarily the OCC. I experienced firsthand how the combination of the iron fist and the velvet glove of CRA and the deep and sincere commitment of the pre-interstate banking executives and local bank board members can encourage innovation. We pioneered an equity equivalent investment instrument that, to this day, provides the financial footing for Arizona Multibank's effective community development lending. Regulators, banks, and the community came up with a viable and lasting capitalization structure for a nonprofit corporation. I provide you this background because I believe it provides a context for the regulators as CRA is revisited and refined. Arizona Multibank enjoys great support from our 18 investing banks, but I think now less so because of CRA and more so because of the personal commitment of local leadership at those banks. Arizona Multibank's current chair from Bank of America has volunteered with us for over 19 years. This bank executive approves $20 million in up loans there and $20,000 loans here. Because of the thoughtful process in our founding capitalization, strong management and board leadership and ongoing understanding and refinement of our business model for community development lending, Arizona Multibank has and will continue to serve the community over the long term. Current CRA regulations undervalue the enormous bank involvement we enjoy and from which the community benefits. The CRA should have greater emphasis on and hence provide a source of encouragement for an investing bank's role in sourcing community development loans that they can't do on their own in whole or in part, their involvement in underwriting of these loans, their share of the actual loans, originated, their utilization of Arizona multi-loans as a credit enhancement for their own loans, their refinancing of Arizona multi-bank loans and participations when a business or project reaches its stride and becomes fully bankable. And especially as Arizona Multibank continues to develop and provide creative and innovative products, their leadership at the board and community level is essential. A bank's initial investment in Arizona Multibank and many other CDFIs and opportunity finance organizations is the gateway to expressing a fuller, tangible commitment to sustainable investment in our communities. It seems that CRA in practice really doesn't assign enough value to the significance of the whole package. From my vantage point, it's not difficult to tell when a bank's activity in the community is a check-the-box entry into the market, and when it is actually a studied long-term commitment to reach further into the community with lending products and services. Community development is local, it is patiently proactive, and success requires a solid commitment in all the areas I mentioned and more. My sense is, however, that the heavily weighted elements of CRA exams measure more discrete, quantitative activities of the bank in silos, rather than looking at the whole farm. In my mind, the whole farm approach encourages and ensures sustainable investment, lending, and services in difficult-to-serve target markets. Finally, CRA measurements of tangible progress in small business lending and housing encourages meaningful financial support in these areas for impact in our communities. Banks get this, are very good at this for their exams, and the benefit for the community is significant. The basis for these measurements grows from what is known and what exists in terms of historical characteristics of borrowers and communities. The cutting edge of community development and reaching underserved target populations in a meaningful way often comes from what is not fully understood today, and lending products that require special partnerships that need to be nurtured and developed over an extended period of time. With success, these customers and products are mainstreams, and we can say with pride that we are systemically connecting financial resources to persons and communities that would not otherwise share in the full potential of the American dream. Engineered financial products should be for the good and not the greed. And CRA is one way that this outcome is encouraged and rewarded. Last, I would be remiss if I didn't mention that today's economy requires not just the focus on community reinvestment, but really affirmatively stemming the tide of unintentional disinvestment. Sweeping actions have been taken because banks are too big to fail. Now it is time to take some courageous action because our communities are too important to fail. Thank you. Thank you.
Thank you. I would note that a finally or a last does get you off the hook with the timekeeper, but you only get one. You only get one.
Conclusion and last.
Right. Mr. Mendez.
Good morning. My name is Fred Mendez. I wear two hats this morning. The first is Senior Vice President of Rabobank NA, with responsibility for CRA compliance, community development, finance, and community affairs. The second is Chairman of the California Bankers Collaborative. My comments, except when noted, represent the collective views of local CRA executives from California Bank and Trust, Citibank, Comerica Bank, Rabobank, and Union Bank. Therefore, these views may not represent the formal views of each institution at the highest level. The format of my comments will roughly follow the topics and questions as published in the Federal Register on June 23rd, specifically those centering on geographic coverage, bank asset thresholds, the activities of affiliates, data collection, and the definition and role of community development. As it relates to geographic coverage, the same bank can differ from one area to the next. For example, it can be heavily reliant on its branch network in a major metropolitan area and find innovative ways to make its products and services accessible to non-metropolitan areas without relying on a large branch presence. As such, a bank's market share of deposits and loans should serve as the primary determinant of its CRA obligation more than the size of its physical branch network. A bank with limited or no branches in a market where it has substantive market share should be allowed to focus on lending and investment activities to compensate for its limited capacity for community development services. Regarding CRA asset thresholds, the current asset thresholds that apply to institutions and tests should at least align with how the FDIC differentiates the industry for asset concentration purposes. To illustrate, as of March 2010, the 105 FDIC-insured institutions with assets over $10 billion represented 77% of total industry assets. The 575 institutions that are considered large banks under the CRA regulation, not including the 105 mentioned previously, represent less than 8. These two groups should not be considered equal. While all banks with assets greater than $1 billion should be examined under the large bank tests, those with assets less than $10 billion should not be compared to those with more. Additionally, given the enormous capacity and scope of banks with assets over $100 billion, some collaborative members feel strongly that those institutions should be compared to each other for CRA purposes and not with large institutions below that threshold. The following comments regarding affiliate activities are those of Rabobank and not representative of the collaborative. For institutions like Rabobank, who are committed to proving that the CRA can align with the business strategy and financial success of a bank, it's difficult to compete with institutions that have separated community development activities from banking by using foundations to underwrite their equity investments and philanthropy. As such, the regulatory standards for CRA activity through bank foundations should be different from those that come from a bank. While bank foundations have made a truly impressive impact throughout low and moderate income communities, it is not banking. While CRA-related activities channeled through bank foundations should continue to be considered under the CRA regulation, the agency should separate the CRA activities of banks from those of bank foundations and ensure that peer comparisons are conducted in a manner that takes the separation into account. The investment test activity of two similarly situated banks within a particular market should not be treated equally if one of the banks uses a foundation and the other does not. Additionally, a bank that does not use a foundation for its CRA activities yet comes close to, matches, or exceeds other banks in the market using a foundation should be given additional consideration. As it relates to CRA data collection, the collaborative suggests eliminating Schedule RCC Part 2 and enhancing, if necessary, the CRA data collection requirements for small business and small farm lending in a manner that maintains its relevance to supervisory function. While I'm at it, you can add CRA Sunshine to the kill list if you're at it. Finally, regarding the role of community development, in addition to impact, community development loans and investments should be reviewed on the basis of sustainability. While each bank has the right to underwrite community development investments and loans as they see fit, the agency should consider whether these well-intentioned transactions may be counter to the goal of long-term economic and community development or damage the brand of community development finance within the industry itself. Examiners should understand the business strategy behind a bank's community development finance program, be confident that it fits within safe and sound banking practices, and recognize the difference between CRA credit grabs and a mutually beneficial and sustainable community development finance program. One way to gather this information is simply to include bankers and community contacts during exams. Thank you.
Thank you. Since we have a somewhat bigger panel and the same amount of time to talk to them, we're going to shorten the question period just a bit, and we'll begin with Mr. Curry.
Thank you, Mr. Walsh. I'd like the panel to elaborate a little bit more on the treatment of community development lending and community development services under the CRA for large institutions. It's been recommended to us by other commenters that we apply a community development test similar to the intermediate small banks to large institutions. If I would like the panelists' views on how they would fashion that test and what differences they would recommend if we pursued that path. Let's start with you, Ms. Glover. Or we can start with Emmanuel, I guess. Give you a break.
Here's the issue, I think, with the community development test as a standalone test. If you remove community development lending from the current lending test, then you're looking at small business lending and home mortgage lending as the primary components of that particular test. Those are really very quantitative in nature in terms of how they're being examined right now. So you're losing that sort of qualitative component to balance that out. Of course, there is performance context that can be considered for small business lending and mortgage lending. But it's really the community development piece that really shows and highlights a bank's efforts in certain activities that the other two categories can't. So our recommendation would probably just weight the community development test or the community development lending portion of the lending test more rather than creating a standalone test for community development. Similarly, with regards to community development services, once again, stripping that out of the service test and focusing solely on branch distribution, you're looking at a comparison to demographics for the most part. And so you really do want to temper that a little bit with more of the qualitative aspects of community development services that really give you a sense of what the outreach the bank does in its communities in that particular test.
Thank you.
I think I'm alive now. Sorry. I would echo much of what Robert had to say. We have to think very carefully before creating a separate community development test about what that would mean to the lending test and the service test specifically, because that would leave the small business and HMDA lending as a very quantitative test for lending with nothing to show what was the entire farm on the lending test, as well as just the retail branches on the service test. With that said, we do feel that community development activities, lending, and particularly community development activities in the service test are undervalued at this point in time, that there needs to be, especially in this economy and the changes that have happened since the examination procedures were put in place, there needs to be an increased emphasis on community development lending and community development activities. One way would be to create that community development test. Other ways would be just to change the weighting and how they're looked at in the individual tests as they are today.
Thank you.
I would say that certainly taking a look at reweighting the test is a good viable option to take a look at as long as it's creating maximum impact. Clearly right now community development lending is very undervalued, as I stated in our comments, as well as a lot of the services. I think the services are being very undervalued in the sense that they are extremely innovative and responsive in actually addressing the needs of the LMI customers, and they're not receiving the credit. So we would support possibly taking a look at a community development test either in lieu of or as an option to the investment test, but you would have to consider reweighting all three tests considerably. I think if you leave it as an optional test, there are some institutions that of course do not have a heavy emphasis on community development lending, since right now it is considered just additive. The one point that I would make on community development lending is that right now it is additive, but sometimes it can only have a neutral effect, and all CD loans should have a positive effect. So again, I think there is a lot of merit in taking a look at it and considering reweighting the tests.
Thank you. Any other comments?
Well, I have a thought that I think it is a good idea to get more emphasis on it, and particularly with the robust CDFI and opportunity finance world, where we see our banks are very much choosing between investment and lending to these CDFIs and organizations. my point really was it requires a good combination of capitalization and finance to be successful over the long term. And so I guess really the point of part of my comment was it's the combination of these things over the long term that work. And I think to Mr. Manuel's part is they change over time. An organization may say, well, I'm emphasizing this today, but the world and the market today needs a different type of emphasis. So I definitely believe community development lending requires much more attention. And right now, as I understand it, it's more frosting on the cake.
What I would add to that is it seems odd that the CRA does not treat all loans equally. All loans seem to have a very important role in each community. That role may be different according to the product and what's needed in each particular community. As such, the idea that structured finance that has as its primary purpose community development should be only given a positive, neutral, or negative impact to the overall lending test when it may be more important than a small business loan or home mortgage lending in that particular area. The infrastructure already exists in the examination procedures and the regulation to just throw community development as well as consumer into the mix to be treated equally as small farms, small business, and home mortgage. I don't think a new test is needed.
Thank you.
Okay. I want to go back to the question I asked the last panel that I said I wanted to ask the bankers. I want to put it this way. How can we, in redoing this regulation, is there a way that you can suggest to us that we can structure incentives such that banks will not feel that every time they consider a new project from somebody, they have to first call their regulator and ask if they're going to get CRA credit for it? You know, how can we structure incentives to make that process, you know, go away or make that not happen?
Want me to start? Okay. You know, I think that part of the problem with that, and I listened to the last panel and what you said about people calling you and asking if you could get CRA credit, goes to the definition of community development. And I think what has happened in the past is that it is such a tight definition that we have to remain within, that there's a number of projects that are out there that we know have impact on our communities, that we know are going to benefit our communities, but for some technicality in the definition have been thrown out in the past. And I think that that drives a lot of the hesitancy of banks to take on the projects that may not have CRA credit because they're trying to fit within a little box of a definition of community development.
It's not really, yeah.
I made a comment in the back of the room when you asked that question the first time to just fire that person and hire somebody at the bank that knows how to figure it out. It's not that complicated. I think the rules are very clear. I think, unfortunately, what has happened is that there are some folks within financial institutions that make it more complicated than it needs to be. As such, the issue of training and education of bankers is key. You know, I'm in front of Mr. Bilsma here, who has his name on 80% of interpretive letters. You don't want to get back into that business.
No.
Yeah, so, you know, it's like, really, I don't think this is necessarily a regulatory issue.
And the other 20% you signed.
Without permission, if I recall correctly.
Yes.
But I don't really see this as a regulatory issue. I really see this as an industry issue to make the case internally and have the right people doing these deals to be able to sell to the examiners why it does fit community development, and if they disagree, to go through the proper process up the chain of command to make that case.
I think it's an absolutely critical issue because I think CRA in most parts is looking in a rearview mirror, and it's not being proactive as it can be in the community. I mean, so if today, let's say if a bank said, I want to make sure a loan that I have foreclosed on or have a short sale, I want to make sure that goes to a family. That would be community development, in my opinion. But they're not doing any new lending. They are taking a new step. They are building, hopefully keeping communities sustainable and stable. But how do you get recognition for that? I think you need a way to respond to what the current environment is. And it's very hard for CRA, in my view, to be nimble in today's economy. And I think it requires, as I mentioned, the courage today to take these big strides. And maybe the mechanism is how to evaluate them if they are more global. I mean, there may be some small ones that need to be done, but if there are some courageous steps that can be made today, how does everyone get together on it quickly to make that type of a more important decision, in my opinion? Yes.
I have an answer to that, because I get asked that a lot from lenders. And I think there's really two reasons why that question comes up, and it's because of pricing. Usually those types of deals will be lower pricing, and so there has to be more justification why we want to do lower pricing on a transaction. And the other is because they are a little bit more complex. There's a lot more underwriting, and there's a lot more due diligence that has to be done on a community development loan. And I think everyone needs to understand, you know, we are going this extra mile, and we want to do this type of loan for our community. Are we going through this knowing that we are at least going to get the CRA credit at the end? And I think that's where it comes from.
There are factors in there now for complex deals. I just wonder, are you saying those don't work? There's to get CRA recognition for deals that are more complex.
Well, I think the CRA officer understands that. And I think they know, okay, I know this is going to be a CRA qualified loan. But I get questioned all the time because I don't know that the lenders always understand that that's going to be a CRA qualified loan. And it's a matter of training.
I would, you know, what I would add is that I think there needs to be a recognition that banks do have some constraints, certainly capital constraints, and it's not so much that they're not trained or that they don't understand what qualifies for CRA, because they do. But when it comes down to it, sometimes you do need to make decisions, and it is based on where you're going to get the maximum impact. And one of the things that is sometimes viewed is where you are going to get CRA credit. Currently, the way that it's structured, I think, is, as you well know, you've got full scope and limited scope areas, and in some markets you need to have a lot more lending and or investment, so decisions are made. And then the other point that I would make is that certainly what may sound like a good deal when somebody calls you after being reviewed by risk and other parties may not be such a great deal from a risk parameters perspective.
Senator, can you ask the question again? I just want to make sure that I understand how you posed it the first time around.
So basically what I'm asking you is what kind of incentive system could we put in place in revising the regulations such that what happens now a lot of times is that we get phone calls from lenders who will say somebody brought in a deal and I'm thinking of doing this, but I'm not going to do it unless I know for sure you're going to give me as my regulator CRA credit.
Because internally, we don't make the distinction between a CRA loan and one that's not. I think there can be incentives in how the guidance is applied. Sometimes there's too much detail in the minutia of what counts and what doesn't count for CRA, that there's a lot of time and effort lost in those discussions internally to try to qualify something as CRA. One of the areas which came up recently in the Q&As was the interpretation around investing in multi-investor funds. And in terms of trying to find the best way to receive optimal CRA credit for those investments that we do, we're actually going the route of the side letter, since it's the easiest to document for CRA purposes on the exam.
Certainly. Ms. Sechrest, during your testimony, you mentioned perhaps a desire for, and these are my words, not yours, greater credit be provided for innovative approaches to providing services in different communities. Right. You mentioned ATMs. What other sorts of delivery channels are you thinking about or are you considering?
Currently at Bank of America, our ATM and our online banking really, as I mentioned, is at parity, certainly from an LMI perspective, at parity with the demographics. So valuing those channels significantly would be important. Mobile banking has completely taken off for us. Right now we have greater than 3 million customers, and we're beginning to see more and more, as we do geocode all this data, that it is heavily being utilized by LMI customers. So in addition to getting innovative and responsive access to the options for delivering banking services, we're also asking for consideration for the innovative and responsive means of delivering products, be they deposit products or credit products. And as I said, savings products, checking accounts, wealth creation. We were, as you may know, back in 2005, Bank of America led and launched the Keep the Change program. And the Keep the Change program is a way to actually have savings built where once you have a debit card transaction, it's rounded to the nearest dollar. That difference is placed in your savings account. Bank of America matches it for the first 3 months, and up to $250 a year. Those types of programs are really literally catalysts and linchpins to actually creating wealth. That program, I think, is nearing close to $1 billion of savings for LMI customers over the 5 years, about $3 billion in savings for non-LMI customers. We would like to see those types of products also be given credit for the innovativeness and responsiveness. Our overdraft policy that we just launched is also one that we're seeking credit for. So I think going back to the question that was asked on community development, making sure that community development services, just as lending, are given a lot more emphasis going forward is something that we're seeking as you consider reforming CRA.
Part of the reason for my question is that our hearing in Atlanta now a week and a half ago, the discussion of innovative provision of services sort of ran up against the wall, which was the ability to deliver, in particular LMI communities, the availability of broadband services, for instance, the availability of cell phone technology or other services, and thirdly, I'll call it financial literacy required in terms of, and the training that's required to get a customer, potential customer, a banking service or a product, bring them together in a way other than walking into that brick and mortar facility. Is this something your institution is looking at?
We are looking at it, and we are actually very heavily involved in financial literacy and financial education. I think in some cases we do try to outsource some of that education to third-party providers, and that into itself is also something that we're seeking additional credit. Sometimes it is viewed that seeking a third-party provider to provide that education, even though they are the most skilled to do it, and that's what we've learned, especially those parties in working with LMI customers, receive less value than if a banking associate delivers it. So we are taking a look at holistically all of the different channels. We're tracking all of the usage of those channels and providing a full holistic view of the education that follows with it.
Good, thank you. And I don't know how much time I have left, but this is a practical question for all of you, and maybe one or two suggestions would be helpful. As we evaluate CRA performance, how do we properly attribute credit for affordable and sustainable lending products? Ms. Glover, I'll start with you.
Affordable and sustainable.
And sustainable. The emphasis is much on the sustainable part as the affordable part.
Right. Well, right now as you're going through the performance evaluation, it's very quantitative. We don't see a whole lot of discussion in the performance evaluation of the sustainability or the affordability of the product. I think you need to look at it over the lifespan. You need to look at it how it performs. Right now we're concentrating very much on originations only. You need to take a look and see how long those loans perform. Come back and look at them as prior period. And lending and investments, you'll look at prior period, but in lending we never do look at anything that happened in the prior period. So I think that may be one way to afford credit for it.
Mr. Benio?
Rather than looking at it from a product standpoint, I think you really do need to look at it from the sustainability of the community. I think this is where we go back to the holistic approach as to, how does a bank make an impact within a given community? And during the time period of an exam, it should be able to demonstrate, to what extent those activities in tandem, work to promote long-term sustainability within a given community.
I would echo what Robert is saying about making sure that you're looking at the viability and the sustainability of a community. Having said that, from a product perspective, I would encourage more view of long-term, whether you're looking at the long-term nature of lending and or investments. And I think someone in the first panel talked about that. We look at it sometimes as just making sure that we've got current period activity, but taking a look at some of those long-term investments that are really catalysts in those communities and providing that credit. And then the other thing from a product perspective is that right now we do look at, especially from a lending side, mortgage originations, valuing rental housing equally. You are providing affordable housing, and there are many folks in today's economic cycles that really cannot afford a home. So as we continue to develop community development, affordable housing, multifamily rental homes, that type of housing should be given as importance of a weight in serving the needs of the community.
Ms. Boone?
I agree with both Robert and Tish in that it is the sustainability of a community and of a neighborhood. And I think we also need to be looking at the sustainability not just of low and moderate income neighborhoods, but also the middle income neighborhoods that are getting slammed because of the clusters of foreclosures. I mean, when CRA originally started, it was because people were fleeing the urban areas and going into the suburbs. And as they left, so did the services. And I think we're seeing the same thing happening, not just in low to moderate income areas, but we're also seeing them now in middle income areas where the services or people are fleeing the neighborhoods, they're walking away from homes, and there's clusters now of foreclosures, and foreclosures breed foreclosure. As foreclosures happen, so does crime come in, and you see people now fleeing neighborhoods. So sustainability, I think we need to look at it. I think we need to redefine it, and I think we need to do more outreach into neighborhoods.
Okay. Mr. Gord?
Yeah, I think maybe you look at it in a different way because we're seeing more and more. I'm kind of focused on the CDFI and opportunity finance world, and investment in lending in an affordable way to them create sustainable organizations to serve the communities at a local level. So the way to look at it possibly is where's the retreating of lending in CDFIs and opportunity finance organizations. What I mean is I'm seeing out there, yeah, we've supported them while they're okay, but when they really need support, operational support, investment, when they need, in fact, additional lending, but they're a little concerned because they're not immune to the real estate problems, there's retreating of lending. So the question is, if you're asking about sustainability, is one way to measure it is if I'm pulling out of a relationship that I've had for a long time, what does it take to stay in that relationship? And it's another way to look at it, in my opinion.
Mr. Mendez?
This relates a little bit in two parts to what Mark Willis talked about earlier this morning with regard to the composition of the examination team that sometimes comes in, not being from the immediate area or maybe even the state and not really knowing the communities. The issue of affordability and sustainability sometimes goes into, needs to be tested in two different ways. One is a product stress test. What's the environment in which you're providing the product? Is it an environment play? Is it only a product that's good for a few years because of the current environment? Money's cheap. You're going to create products that are within that vein, and you have to be upfront with the examiners about whether or not this is going to be a product they're going to see if the environment changes. The other one is whether or not it's a long-term sustainable product, something that's core to the business plan of the bank. And the third is whether or not there are external factors involved. I've read a few different studies, and actually in the Central Valley have seen examples of redlining, but not by banks, but local municipalities. You go into a community that hasn't had its roads paved in 15 years. They shut down the fire station. They closed down the police station. And I'm getting hit over the head for not making real estate loans there. There has to be an education there. And you see the examiner's eyes open wide, and all of a sudden they're like they're in school. You need to be able to make that case. But I think having a certain basis of information into the context and the environment in which they're going in is important. And then finally, one of the most important things I think the examiners need to take into consideration is not the deals you did, but the deals you lost and why. Particularly in the early 2000s, my head of community development finance, Frank Bravo, actually started coining the term predatory borrowers in the community development area because we were competing on underwriting standards that bordered on safety and soundness. And I think it's important for examiners to understand the fact that there's a line that some banks are not willing to cross in order to get a community development deal. And that impacts whether or not that money is going to be available if the economy turns in 5 years. And that is no longer an affordable product for that bank to offer, and the community really relied on the cheap money. So those are stories that both the industry needs to tell, but the examiners need to be prepared and have a context from which to assimilate into the CRA exam process.
Thank you. A couple of things, both in the testimony and some of the comments about small business lending and also foreclosure prevention and neighborhood stabilization. They point to issues that clearly affect community cohesion, sometimes community development, stabilization, and certainly in the small business area, it's very much a focus of attention in Washington these days. How do we encourage credit for small business as a means both of promoting economic recovery but also community development? But in a number of ways, the suggestions and ideas that have been put forward seem to wander away from the sort of low and moderate income focus in the interest of achieving a kind of broader objective, if you will. I mean, I think the same objective, but kind of breaking that link to some extent. So increasing the size definition of small businesses, or removing an LMI area only designation for a small business, or including a number of specific elements, as was in your testimony, Ms. Sechrest, I think, kind of specific things to add. And on the foreclosure prevention and neighborhood stabilization, that there are clusters of foreclosures that occur that seem to become kind of endemic or systemic or something like that. Shouldn't we be doing something about that? I just wonder whether, though, if we head in directions like that seem to break the link to low and moderate income, where we're not asking this system to do more than it is intended to do. I mean, should we be kind of heading off, outside the boundaries of where we have been, even in the interests of pursuing a very worthwhile objective?
Well, I think on that point, the CRA, when it was written, the institutions were to serve the financial needs of all its communities, including low and mod. So I think given the environment today, with the need for job creation, regardless of income level, I think, institutions should receive favorable consideration for all of the small business lending that they're doing. In addition, just because a small business is located in a low and moderate income area doesn't necessarily mean it's attracting employees within that area. Likewise, if it's in the middle and upper, it's not necessarily just getting employees from that particular. So I think given the needs of the current environment, a broader definition in terms of responsiveness to what's most critically needed in the communities, that I think is in line with the spirit of CRA, even though the definition may not be in sync.
Yeah. Others?
I would echo what he's saying. I think a broader definition, as we provided in our testimony, where you're looking at, we stayed within the $5 million revenue size. We're basically saying all loans with that less than $5 million, again, to broaden that definition. And going back to the loans in LMI communities, we're actually asking for any loan size within the LMI community because, again, it is providing a catalyst there for that community as well as helping create jobs. I think making sure that we've got a rounded definition where you are including all of the technical assistance that's being provided to small businesses. It's not just about the loan itself, but all the small business technical assistance that's provided could obviously be something that should be addressed. And then lastly would be, if you're considering size and if you're wanting to really focus on the loan size less than $100,000, again, you could take a look at that, and that was one of the options that we mentioned as possibly looking at that. We do provide that data, but looking at that for extra credit.
I agree. I believe we're in a different environment than we've ever been in before. Individuals now have lost disposable income. They've lost value of their assets. And I think because of that, we need to react differently and expand our scope to not just include low to moderate, but also middle income only in certain areas. And I emphasize those areas would probably be financial literacy, and also in neighborhoods that are faced with foreclosures, have cluster foreclosures. I'm not saying we should expand every avenue for middle income, but I think we should limit it, but I think we should expand the scope.
I think you raise a really good point. Arizona, probably at any day, you'll see 100,000 foreclosures in Arizona. And that's steady, with new ones coming on and other ones moving off. And we have beautiful subdivisions that have been built with high foreclosures. We have $235,000 mortgages on houses. The houses are now going for maybe $100,000 and a quarter, maybe less. Affordability today, the house is done. We don't have to subsidize someone buying a house that's affordable. So what we're really saying is it may not be a low and moderate income community, but don't we strive for mixed income communities? And so it seems to me that's the opportunity that we may be missing, is connecting people to the houses that are affordable today, which was to my previous point. So I think it's vast, and in Arizona in particular, we feel it. And what frustrates me probably the most is this biggest problem is the biggest opportunity we have right now in order to, I think, build affordable communities for people who are most in need of those. So it's a good question.
This goes back into two different issues that were raised. One is giving community development a more prominent role, particularly for lending in the exam. And the other one is how hard some of us as bankers are willing to work within the definitions and footnotes of the regulation. The flexibility exists for us to be able to consider loans to businesses that meet the size parameters of the SBA's SBIC and SBDC program and satisfy the regulatory definition of the size and purpose test to increase or attain, retain, attract employment for LMI communities or LMI individuals. That's a big loophole to be able to capture a lot of information as community development loans. Well, the work required to be able to gather that information and then be able to report it and provide it to examiners is not necessarily worth neutral, positive, or negative impact in the overall lending test. So there isn't really an incentive, but if community development lending were given a more prominent role, similar to that of other lending products, then I think that issue would take care of itself. Obviously, when you come up with a number like $1 million of fiscal year in revenue, and you came up with that in the mid-90s, probably a good idea to tie it to something that moves. So the idea of tying it to an SBA definition or something else you guys find would probably be a little bit more relevant.
Well, we are within a few minutes of the end of our program. I do take note in both of the panels that there has been reference a couple of different times to the obligation that we as regulators and others in government are under to make sure that as the new Consumer Bureau is created, that we make sure that there's coordination of the sort of rules and procedures put in place there to things like CRA and many other areas of the work that we do, but we will have to be mindful of coordinating those things so that you don't have conflicting or kind of an accretion of requirements in the same area. I would just mention one personal anecdote. I've done some work in Africa over the years to the question of service delivery, and having gone to one area in Kenya some years ago, communication was impossible. You'd have to drive 20 miles into town to find a phone to do whatever you were going to do. And a few years later, talking to someone in the area about, well, what should we do about communication? And the answer was, well, why don't you just get a cell phone? Because there was cell service now in the place that was completely off of any network that one could possibly imagine. And then a few years after that, I was reading an article that said the penetration of cell phone-based banking into those areas of semi-rural Kenya was now quite high and growing. So it is certainly the case. I mean, I think Africa is often a case where they kind of leapfrog by just adapting to new technologies and in fact, in sort of surprising ways. So it may be that we will be seeing more of that. With that, let me thank the witnesses for your remarks.